The purpose of this video is to show you how to handle a down payment from a customer if you are using QuickBooks Online. There are multiple ways to do this, but the way that I'm going to show you today is the way that I recommend to avoid some issues like having your accounts receivable report cluttered up, and also from having your accounts receivable report sort of falsely reporting your open invoice balance, and a few other issues that we're trying to avoid here. So the way that I recommend doing it is by using a non-posting transaction. And in QuickBooks Online, a non-posting transaction for receiving down payments would be an estimate. And I'll show you how this is going to work. So first of all, before we go anywhere, I just want to show you what happens if you do what most people do by default, because it just seems like the logical thing to do. So they have a customer who's giving them, say, a $1,500 down payment on a $3,000 job. So they get the check in hand and they come into QuickBooks and they receive a payment for that customer. So they put in the customer's name and the date that they received the payment, maybe the payment information like their check number, so on and so forth. They put the $1,500 in. Now this particular customer does have an open invoice, but this $1,500 payment has nothing to do with that invoice. So we don't want to check this off because we're not going to apply it to that invoice. We just want to keep this $1,500 payment as a credit on their account for when the job is complete and we bill the customer. So what this is telling us is if we were to record this transaction right now, that it will create an additional credit in the amount of $1,500 for this customer. So I'm going to save and close this. Now, if we look at our accounts receivable report, by doing this, we will see what happens. It's going to give you a little warning here, just making sure that this is really what you want to do and that you didn't just forget to apply this to an invoice. So yes, we want to save this as a credit. Okay, so now I want to go look at my accounts receivable report to find out what is happening here. So if I go to reports and I choose, and it's under your favorites here on the standard tab if you're looking for this report. So this is your accounts receivable aging summary, and this is basically just a summary of all of the open invoices that your customers owe you money for. So, and you can change the date to whatever you want to, but normally you would want it to be as of today because you want to know as of today who owes me money and how much do they owe me. So that's what we have here on this report. Well, if we look at Bill's Windsurf Shop, we now see that he has a negative balance on the accounts receivable report because we have a credit on his account. Now, really, what's the big deal, you're asking? Well, it isn't the end of the world, but as you start to get bigger and more complex, and maybe you want to start doing some financial analysis and really start looking at, your business and ways that you can improve, one of the things that you might look at is how many days does it take me on average to collect open invoices? And that calculation is called days sales outstanding. Part of that calculation takes the total accounts receivable balance. So if you have a bunch of customers who are giving you down payments, and especially if they're larger down payments like this is going to throw your number off because this is going to falsely reduce the amount of open invoice balance that you have here because it's subtracting all of these negative amounts. So now in a way, some could argue that, in a way that's kind of correct because you've actually received payment for these before you've even billed them. So that's reducing the amount of time that it took you to collect on that invoice. But I really would just rather see of the customers that I've already billed that owe me money, how many days on average does it take me to collect from them? So for me in particular, and for a lot of business owners, we don't really want this number thrown off by large negative numbers here like this. So how do we avoid that? Well, the first thing that you will need to do is make sure that you have partial invoicing set up in your QuickBooks Online company. Now, I don't believe that this option is available in all versions, so I don't know right off the top of my head which versions allow it, but if you try to do it, it will let you know that your version does not support that feature, and then you would either need to upgrade or, find a workaround for it. So in this particular case, we are going to go, and I'm working in a sample company here, so, just so nobody thinks I'm using actual client data, but this is a sample company. And I'm going to go over here to the gear wheel, account and settings. Once in there, I'm going to click on sales on the left-hand side here, and I'm going to scroll down to progress invoicing. So right now, creating a partial invoice from a single estimate is off. I want to turn that feature on. So I'm going to click the little pencil over here on the right-hand side, and I'm going to select that to turn it on and click Save. Okay, so now I have done that. So now a customer is giving me $1,500, and instead of just receiving the payment and creating a credit on their account, what I'm going to do is use a non-posting transaction to get the job on the books, if you will, but not have it actually recording on any of my financial statements. So the first thing I want to do is create an estimate. So if you click New over here, an estimate, and select your customer, and I'm going to use a different customer now because I want to be able to clearly see how this comes out. So we'll use Cool Cars, and let's say we're going to do a $3,000 job for them, and we've received $1,500. Now, you could say, well, why don't I just invoice them the $3,000 and then just apply $1,500 to it now, and then at the end of the job, apply the other $1,500. Again, you can do this, but if you're really trying to do accrual-based accounting and you really only want to see your revenue when you've actually earned it, then I would suggest using this method rather than creating the whole invoice for $3,000. So what we're going to do instead of creating an invoice is we're going to create an estimate, and basically the process is exactly the same as creating an invoice, except that this will not post to your sales account just yet. So if we think this is going to be a $3,000 job, I am going to fill this out and make the estimate for $3,000. And the nice thing about this is if it ends up being more or less than $3,000 at the end of the job, because it's an estimate, you can go and change that at the end of the job to be whatever you need it to be without affecting transactions in a closed period. So let's say you started the job in May and you created the invoice for $3,000 in May, but when you finished the job in June, you realize that it actually took $3,500 to do the job. So you need to add another $500. Well, you've already paid sales tax on that May invoice. So if you were to go in and change it now, your sales tax return for May is going to be off. It's going to be wrong, and you'll have underpaid your sales tax. So you don't really want to do that. So by doing an estimate first, it makes it very nice and easy for you to make these changes without having to worry about messing anything up that you've done in the past. So we're going to create this invoice or this estimate for $3,000, and we're going to save it. And once we do that, it gives us the option to create an invoice. Now, I do want to create an invoice, but I only want to create an invoice for the amount I've so far received from the customer, so the $1,500. So I'm going to create an invoice, and here it asks me, how much do you want to invoice? So do you want to invoice the full $3,000? Do you want to do 50% of each line or whatever percentage? Let's say you collected 20%. You could do 20% of each line. Or do you want to do a custom amount for each line? So maybe you want 50% of the labor up front, but you're not charging them anything for any of the product that you're selling as part of this invoice. That's where you would use this customize feature. But for the purposes of what we're going to do today, we're just going to say we're collecting 50% of the entire job. And so we're just going to choose this. We're going to use the 50%. So we're going to actually create an invoice for $1,500. So now we create the invoice. One nice thing is this is linked to that estimate. So if we ever need to refer back or, try to remember what happened here, if we click this little linked transaction, we can see that this is linked to this estimate for $3,000. So we have our invoice, 50% of $3,000. It's giving us the $1,500. That's all fine and great. And we can save that. And now we want to apply that 50% down that the customer gave us, so we can just click on receive payment here, and we can receive the check for $1,500 and apply it to that invoice for $1,500. Now there will be nothing open on our accounts receivable report, and if we go back into that estimate, so I just have to remember, because I don't use estimates that often, to be honest with you, so I always have to remember where to find them. But I think, not there. They are Okay, there doesn't seem to be anywhere where you can find actual list of estimates, but one way that you can find them is by going into the customer record. And we click sales customers over here on the left-hand side, and then we can just search for our customer here, and then the estimate will be in the list. So here we have our estimate, okay. And basically what this is saying is that $1,500 of it has been invoiced, $1,500 is okay, so we get to the end of the job. We want to invoice this out. And also, we ended up ordering some lighting also for this particular job. And so we have some items to add to this, but we're not going to add them to the estimate. We just want to get the rest of this estimate turned into an invoice for right now. So we're going to bill out the rest of the $1,500 here. So we're going to say create invoice, and we're going to say remaining total of all lines. Now, what you could do is, break this into as many payments as you need to. Some jobs go on a really long time, especially in construction, where you may be getting, construction draws periodically. So this works really great for that because you can do this as many times as you need to. But for right now, we're just going to bill out the remaining. So we're going to create our invoice. Yes, we want to leave. Leave without saving. Why would we do that? So we have our invoice created now for $1,500. This is saying, again, $1,500 of $3,000. We're still linked to that estimate for $3,000, but now we need to add a little bit extra because we had that lighting. So we're going to go ahead and add our lighting. And let's just say this happened like the following month. So I think our last one, we did it in June. Let's make this one July, say July 2nd. We're going to add on our lighting. And lighting is a taxable item. So one of the great things about doing it this way is that we would have had to go and edit our June invoice, adding another $500, and now all of a sudden we owe tax on an invoice that initially in June we didn't. We already filed our June sales tax return, so we don't want to mess with that anymore. But now we're not messing that up because that invoice was created in June. It's got a payment applied to it. It's done and over with. We're good to go. Now we're invoicing in July. It's the end of the job. We have an additional $500. It's subject to sales tax, but we're taxing it in the correct period. So we don't have to worry about creating any type of a mess on our books or anything like that. So we just choose our sales tax entity here so that the proper sales tax gets applied, and then we would save this, and if we had a payment from our customer, we would go ahead and apply the payment. If we don't have a payment yet, we would just send the invoice to the customer and then wait until they pay us and receive the payment at that time. But now you have handled those down payments in the proper way so that you keep your accounts receivable report clean, and you're not messing with any prior periods and making changes to things that you're not quite sure how they're going to come out in the end. So this is how you do it. And if you have any questions or would like further information on similar situations, or if you have unique circumstances in your business, please feel free to reach out to us. You can find us on the web at prosperitybookkeeping.net, and otherwise, you can always give us a call as well, 920-309-6660. Thank you.